We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Also with us today is Arrin Wray. He joins us as well. He's been on the program before. But Brian and Arrin are going to talk to you today about some tax strategies. It doesn't matter if the markets are rolling along or if the markets are down. Taxes are a big thing in retirement. It's a part of the planning process, the safer retirement process that Brian and Arrin and the team at Decker Retirement walk you through. It's about income. It's about investment. It's also about taxes, health care, estate planning, legacy planning, Social Security, Medicare. There's a lot on your plate as a retiree. Today, Arrin and Brian are going to focus on taxes. If you'd like to learn more and you have questions maybe, give them a call. There's no cost to chat with them. Maybe the most important phone call you make when you think about it. 833-707-3030. We'll give you that number throughout the program, but there's no cost. Brian and Arrin and the team don't know if they can help you until you reach out. They'd love to see if they can help. 833-707-3030. And I always say this at the start of the show. The website to learn more is deckerretirementplanning.com, deckerretirementplanning.com. And on that website, there are about 12 things I think you can download, including Brian's book on retirement, The Decker Approach. There is the 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. Those are just 4 of the 12 things you can download. That is on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. It's all there just for your information. Maybe you get it, then you have some questions, call them, 833-707-3030. So today, Brian, you and Arrin, it's all taxes. Is that right?
All tax strategy, because we want to pay our fair share, but we don't want to pay more than our fair share. And saving for retirement and knowing about these tax strategies is very important. Arrin, let's start with the biggest tax strategy available to most all people, and that would be the Roth conversion. Give us a definition, and then I want to provide some numbers.
Yeah, absolutely. So what most people do during their saving years when they're building up that asset base, that nest egg, is they put money into what are called pre-tax accounts. So this is going to be your company 401k, a traditional IRA. Those are monies that are not yet taxed, goes into the account, funds grow tax deferred, and then you pay your regular income tax rates on distributions. In contrast, there's another qualified account or tax-advantaged account called a Roth IRA. Now, the difference between this and a pre-tax account or a traditional IRA is how the taxes are handled. So it is a post-tax account, meaning the money is taxed first, but then once it gets into that Roth IRA account, it grows tax-free. You can pull money out of it tax-free, and that passes to your beneficiaries tax-free if you, as the account holder, don't end up spending all of that money. So from tax-advantaged accounts, you have the pre-tax, the post-tax, and a lot of people kind of get into this autopilot mode where they start a job, they get signed up for the 401k plan, they just do whatever the default setup is. That's typically just a pre-tax contribution. And then they just do that and they get to retirement and realize, hey, I have this giant amount of money, this giant pot of money, my 401k, that I now have to worry about paying income taxes on. And so what we want to talk through is a better way to still save for retirement, but do so in a much more tax efficient, tax advantaged manner, which is taking advantage of some of the Roth IRA or Roth 401k options there. So this is something that we help almost all of our clients do, is what we call strategic IRA to Roth conversions. So the way that we do this is by looking at clients' tax situation of where they're at in those federal marginal tax brackets, whether you're 12, 22, 24, 32, whatever it is, and make a determination based off of where you're at now versus where you're going to be at later or in retirement on whether it makes sense to do a Roth conversion. So most of the time it does. There are occasions where it doesn't make sense. If you're making $500,000 or $600,000 in income now, your projected retirement income is going to be a little bit lower. Probably not going to want to do a Roth conversion now. We'll wait till a little bit further down the road. But if your income is about the same as it will be in retirement, or if your income now is a little bit lower than it will be in retirement, then definitely taking advantage of some of those Roth conversions is going to be helpful for you. So anything you'd add to that before I jump into an example, Brian?
Oh, no, I wanted to use that example. Hit that. Those numbers are pretty amazing.
Yep. So what we want to compare here is two individuals with the same amount of money, but that have handled the taxes on that amount of money a little bit differently. So situation one is a client, 60-year-old individual, $1 million in a pre-tax balance, traditional IRA, 401k. That person grows that $1 million balance by 6% per year until they hit what's called required minimum distribution age. So we're going to use age 73 for this. Again, depending upon your birth date, it's going to be either 73 or 75 for you. But at a 6% rate of return, after that 13-year period, that person has about a little over $2 million, $2,056,000. Now, at that point in time, they have to take what are called required minimum distributions. So if you're not familiar with this, this is the IRS essentially saying, hey, you've had long enough to defer the taxes on this money. We're going to start forcing you to take withdrawals out of that account, and the distribution amount, the percentage of the account you have to withdraw, gets bigger as you get older. So in this example, the first year RMD was about 76,000, year after is 80, then 85, 90, 95, and so on. So by the time they're age 90, their RMD is about $182,000. So here are some issues or problems with going with this traditional route where you don't do any strategic Roth conversions. Problem number one, you eliminate the flexibility around when you withdraw that money. So when you get to RMD age 73 in this example, you don't have a choice as to whether you pull that money out of the account or not. The IRS puts penalties on that if you do not abide by those required minimum distribution amounts. So most of the clients that we work with are going to have multiple sources of income. You're going to have Social Security, you might have a pension, you might have rental income or other things, other assets that are going to provide you with taxable income. If you are also forced to make the withdrawals out of these pre-tax accounts, it typically pushes you into a higher federal marginal tax bracket. And you may or may not have even needed the income. So if you don't need that money to live off or don't want to withdraw it, again, you don't have a choice. You have to take those withdrawals. The second problem is that tax liability also passes to your beneficiaries. So when you pass away, you give those assets to your kids or other younger beneficiaries. They have a 10-year time window within which they have to withdraw all of the money out of that IRA account. So what typically happens is they're likely younger than you. They have their own taxable income coming in. So again, taking the IRA withdrawals out typically pushes them into a higher federal marginal tax bracket as well. So it typically guarantees for you a higher federal tax bracket in retirement, does the same thing to your beneficiaries. Here is a better way to be able to approach that same account, that same amount of money. So if instead that 60-year-old individual with that $1 million IRA balance did consistent IRA to Roth conversions, meaning you pull some money out of the account, pay the federal and state income taxes, then move it into the Roth IRA account, here's the outcome of that. So in our example, we start pretty heavy with the conversions, $225,000 a year for a 3-year period, and then $50K a year thereafter. In this case, by the time they hit required minimum distribution age at 73, there are no RMDs because there is no IRA balance. So the IRS doesn't care when you pull money out of a Roth IRA because they get no additional tax revenue from doing so because you've already paid the tax burden on that. So here's some advantages to going with this route. Advantage number one, you have much more flexibility in when you withdraw those assets. So like I mentioned, there is no required minimum distribution. So if you decided that you wanted to spend all of the money, some of the money, none of the money, if you wanted to just let it grow indefinitely, pass that to your beneficiaries, you can do any or all of those things. So you don't have those annual distributions that you're forced to take on that cadence. You're welcome to delay that or defer that as long as you would like. The second thing is that advantage tax-wise does pass to your beneficiaries. That same 10-year time window still applies as far as the timing of when they have to withdraw those funds out, but they wouldn't pay any additional taxes on the distributions there. And then one final one that I'll add is a lot of our listeners, a lot of our clients are couples that file taxes married filing jointly. which means that eventually one of you two is going to pass away. And at that point in time, even if about the same amount of taxable income is coming in, your overall effective tax rate, your effective tax burden increases dramatically because you are now a single filer instead of a married filing jointly couple. But again, if you have a large balance of Roth IRA funds to pull from, that's going to help you dramatically decrease your tax burden and effectively manage and mitigate that over time, because the distributions from that account don't incur any additional income tax obligation. So one thing to think about for married couples there. So let me kind of walk you through a side-by-side comparison from a number standpoint. In the pre-tax example, meaning doing no Roth conversions, just leaving everything in those traditional accounts, in our example, you'd pay about $656,000 in taxes, pass that money to your beneficiaries. Their bill's about $807, total taxes paid of about $1.46 million. The net value they would receive after tax is about 1.4. Contrast that with the proactive.
Wait. The net value to heirs is 1.2, isn't it?
In this example, where RMDs are at 73 instead of 72, when they change that, it's going to be, just under 1.4. And then for the after-tax numbers, if you were to do the IRA to Roth conversion example, you'd pay about $300,000 in taxes yourself versus about $656 in the pre-tax example. Total tax bill, and for both of you and the beneficiaries, is about $333. So it's about a $1.1 million tax savings. And then you look at the net value your heirs or beneficiaries receive. It's about $4.2 million versus about 1.4. So again, Brian and I want to drive home that this is likely to be one of, if not the largest tax saving strategy available to you for the remainder of your life. So if you're not already looking at IRA to Roth conversions, you absolutely should be. And this is something that we can take care of for you here at Decker Retirement Planning. And we put together a financial plan for you. Again, we're very math-based. We're very numbers-based. We'll be able to tell you year by year how much you should do from a Roth conversion and be able to take care of all of the forms to get that actually taken care of for you as well.
Arrin, let's go through how we actually do the calculation of how much should be converted from IRA to Roth. And by the way, a Roth account grows tax-free, distributes income back to you tax-free, passes to your beneficiaries tax-free. Arrin, cover how we do the calculation and also why we wouldn't do it on any of the principal guaranteed accounts.
Yeah, absolutely. So the goal here really is to be able to pay the taxes when they are going to be the least. So the fundamental decision that you're making when deciding whether or not to do a Roth conversion is, am I going to pay more taxes on the money by deferring them, just taking those distributions later on from the IRA account, or am I going to pay more by doing the Roth conversion now? So that's the question that you're looking to answer. So the way that we answer that, the way we come to a hard and fast number on that, is by building financial plans for our clients that outline all of their income streams and taxable income to see where they are in those federal marginal tax brackets. So just rough example here. Let's say that you're an individual that has a, $230,000 income. That puts you as a married filing jointly couple into the 24% tax bracket. From there, we would look at where the top of the bracket is. So for this year in 2025, top of the 24% bracket is $394,600. Then from there, you also do get to include either your itemized or your standard deduction on top of that. Standard deduction this year is $30,000 for a married couple. So in the 24% tax bracket, you can have about $425,000 in income and stay within that same tax bracket. Our goal is to not push you up into the next one. We don't want to have you make that jump from 24 to 32% federal marginal brackets. So we would help you figure out from where your income is now to where the top of that tax bracket is, what the difference between those two figures is, have you do that amount as a Roth conversion, and then continue that process year over year to chip away at that pre-tax IRA balance, get more of that money over into the Roth category.
And of course, if you would like to find out where you are, maybe it makes sense for you, maybe it doesn't. Not everybody should do Roth conversions, but if it makes sense for you, it can be an incredible thing for you and your future. Brian and certainly Arrin and the team at Decker Retirement are here to help you figure that out. The number is 833-707-3030. And you don't just go, I need some tax-free money. I think I'll just move some money from the 401k or IRA into a Roth. No, there's a strategy involved in all of this, and amount is involved. There's really, I think, some intricacies that you don't want to overlook. And Brian and the team, Aaron and the team at Decker Retirement are here to help you. 833-707-3030 is the number. Again, there's no cost to you. Might be the most important phone call you make. 833-707-3030. Brian J. Decker, Arrin Wray, back with more of Safer Retirement Radio right after this.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. You can always learn more about Brian, Aaron, and the team at DeckerRetirementPlanning.com under the heading of Safer Retirement Education. 12 different things you can download, including Brian's book, The Decker Approach Book. That's all on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. If you have questions, you have concerns, you want to learn more, it's 833-707-3030, 833-707-3030. All right, you boys still talking Roth conversions, Brian?
Yeah, we're going to tie up a couple loose ends on this. So, Aaron, let's talk about the incremental tax rate change. Not a big deal from 22 to 24, but it is a big deal from 24 to 32. Talk a little bit about that and why we would concentrate on risk money over principal guaranteed accounts.
Yeah, absolutely. So if you think about the fundamental question that you're asking on Roth conversions, again, it's really when are you going to pay the least amount in taxes on that money? And so when we look at the tax brackets to do those Roth conversions within, our goal is to keep people out of the 32% bracket and above. Now, again, every case is individual. There are rare occasions where we do Roth conversions up into the higher tax brackets. But for the most part, it's best for the majority of people to stay 24% or below. Now, the difference between the 22 and the 24% bracket is very marginal, right? It's only a 2% jump. And so we encourage our clients that are in a advantageous tax situation to convert up through the 24% bracket to take advantage of those lower income tax brackets over time. If you look historically, the federal marginal tax brackets we have now at 10, 12, 22, 24, and so on are actually pretty low relative to where they have been in the past. And right now, if there is no new tax legislation passed, the brackets are set to adjust starting next year in 2026. The Tax Cuts and Jobs Act has that expiration date where it reverts to the previous income tax brackets, which are 10, 15, 25, 28. So a lot of those brackets do go up by a few percentage points each. So where we have a kind of a window here, and again, it is possible that those taxes get extended out, those tax cuts get extended out, but doing that Roth conversion now, even at a 24% bracket, is very likely to save you on taxes down the road, where your retirement's going to be 10, 20, 30 years long. That's a long time out to plan for taxes. And doing those conversions now is a form of insurance against future tax rate increases, where let's say you're in a 24% bracket now, and 10 or 15 years from now, you're in a 28 or a 30% bracket based off of tax rate adjustments. You don't have to worry about what they increase those tax rates to, because you have already front loaded, you've already paid that tax burden. You don't have to worry about that for those Roth IRA funds anymore. And then as far as the source that we use to do those Roth conversions, like Brian mentioned, we typically focus those conversions within funds that are held in what's called our risk bucket. Now, we do that because they have a long time frame from an investment horizon standpoint. It doesn't really make sense to do a Roth conversion and then spend the money the next year or 2 years later. You don't get the long-term compounding tax advantages of that Roth IRA money by doing conversions and then spending the money in the near term. And so our conversion strategy is focused on that risk portfolio, on the longer time frame investment strategies to allow that money to be able to grow compound tax-free so that you have a large bucket of tax-free money to be able to withdraw from in the future.
All right. I think we wrapped it up on the Roth conversion. That's going to be, in my opinion, the biggest tax saving strategy for most everybody. Bankers and brokers, a lot of them will say, yes, Roth is important, but they find it difficult to quantify how much to do, is what I'm finding, Arrin, because they use a pie chart. How can you know from a pie chart how much income you can draw each year? By the way, that brings up the 4% rule. That's for another show, but we've warned people as a community service that the 4% rule can actually destroy your retirement plan. So we warn you against that. But let's go to the next strategy. I'm going to give you a situation, and then you tell me the strategy that might help me. This is something that we do here at Decker. It's called placement. Let's say I've got qualified and non-qualified funds in my retirement plan. How is that a tax strategy, Arrin?
So the ordering in which you use those funds has a dramatic impact on how much value you get out of them, meaning like what your net take home of that is. So there's really three tax types of money. You have IRA or traditional IRA funds. Those are pre-tax dollars. You have Roth IRA funds that are post-tax. That's what we just walked through in that example. And then you have non-qualified money. This is also referred to as after tax. This is the same money that you have sitting in your savings, your checking account. It's money that's already been taxed, but you're going to pay taxes on whatever the growth of that asset base is. So most of our clients have all three tax types of money, and they say, hey, where do I invest this? How do I maximize what I'm going to get out of this? I want to make sure to do this in as tax efficient of a manner as possible. So the way that we help allocate those funds is through that term placement, meaning where we allocate that money, like what types of investment strategies we use and when it's spent, is very purposeful. So here's how that works. We typically preserve Roth IRA funds as long as possible. This is not the money that you want to use right at the beginning of retirement as income. You want to have that in long time horizon investments so that you can compound that tax-free money, use that later on when it's grown and you have the ability to take those tax-free withdrawals. From there, we'll then move to the traditional IRA, those pre-tax funds. These are funds that also have a tax advantage while they're deferred, but you are going to pay taxes income-wise, income taxes on the distributions. So we'll fill in the rest of our risk account and then some of the longer dated principal guaranteed accounts that are going to be used for income a little bit later on. The third category then gets into the non-qualified or after-tax funds. So this is where we use those funds at the beginning of the plan, typically the first source of income that you're going to withdraw from. And this does a couple things for you. Pairing with the Roth conversions, when you have the majority or all of your income in a given year coming from non-qualified or after-tax funds, it means that your taxable income for the year is going to be really low. So maybe you're pulling, $100,000 a year out of the non-qualified funds. You might have a small amount of Social Security or other taxable income coming in, but that gives you a really big margin between where your taxable income is and where the top of that tax bracket is to do Roth conversions on. So that really helps to front load the Roth conversions when you can use non-qualified assets at the beginning. And again, they don't have as much of a tax advantage as the IRA or the Roth IRA funds. So we typically use them first and then move on to those tax advantage funds for the second and third categories a little bit later down the road.
Now, Arrin, there's a right and wrong way to take required minimum distributions, isn't there?
Yes.
When we talk about taxes.
Yep. So there's a couple different things to consider here. So again, RMDs are going to be on any pre-tax balance. And basically the way that it works is they add up the total dollar value of all of the pre-tax dollars that you have. So this could include your 401k and any traditional IRAs. And you have the ability to be able to pull the money from any of those accounts. It doesn't have to be equivalent increments from each account or each investment. They just care that you pull the total dollar amount out that required minimum distribution specifies. So there are some tax strategies that you can employ to be able to minimize this. One of the ones that we see pretty commonly is by using what are called qualified charitable distributions, or QCDs for short. So a lot of our clients have charitable inclinations. They give money to a church, a school, a hospital, any kind of 501c3 organization. And one of the things that you can do is do a donation. The technical term is that qualified charitable distribution to that charitable institution from your pre-tax account, the IRA. And that does satisfy that RMD requirement. So it gives you the ability to satisfy the withdrawal amount that the IRS has specified for you, but it does not increase your taxable income. So let's take an example and just say in 1 year, your required minimum distribution the IRS specifies is $30,000. Instead of pulling that money out and sending it to your bank account where you would pay federal and state income taxes on it, you decide, hey, I want to send this to my favorite charity or to the church that I go to, and you send that money directly from your IRA account over to that charitable institution. That does not count as a $30,000 distribution for you, meaning that there's no taxes due, and the receiving charity gets to have that full value. They don't pay taxes on that amount either. So if you do have consistent or even inconsistent charitable contributions or donations that you want to make, doing a qualified charitable distribution can satisfy that RMD requirement for you and help you reduce the amount of taxable income that you're going to have that year.
So qualified charitable distributions, Roth conversions, required minimum distributions. There's a lot on your plate. Brian J. and the team at Decker Retirement are here to help. Arrin included, obviously. It's 833-707-3030. Again, there's no cost to you. This can get pretty complicated, what they're talking about today. And you make the wrong decision here, it could be super costly, that's for sure. 833-707-3030. Call them today. What a great opportunity for you. There's no cost. 833-707-3030. Halfway through today's Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Back with more right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can learn more on the website, deckerretirementplanning.com. A lot of information on there. 833-707-3030. If you have questions today, we're talking taxes, basically. We're talking required minimum distributions, charitable contributions. We're talking Roth conversions. That's a big one. 833-707-3030. If you'd like to figure out how does this really affect me, should I do Roth conversions, should I not? They're great for some, not right for everyone, though. 833-707-3030. All right, Brian, the last half of the show, where are you and Arrin going in this half?
We're just going to cover different tax strategies to cover the rest of the show. So in this case, let's say I'm 63, 64, something like that, Arrin, and I'm going to exercise some stock options and spike my income. Is there an offset tax strategy that can bring that taxable income down?
Mm-hmm. Yep, absolutely. This is a pretty cool strategy where we have a lot of clients that, like you said, will have spikes in income. A lot of them want a way to be able to control that. and also have charitable inclinations. So we talked a little bit about the QCD, being able to donate to help with the RMD management there. This strategy is a special account that allows you to be able to donate funds to it that give you an itemized deduction in the year that you make that donation. So let's just say for this sake of example, you're going to donate, 70 grand to this account. You would get an itemized deduction for tax year 2025 of $70,000 that you could use to offset that spike in income that came from exercising those stock options. Now, from there, you do still control how those funds are going to be invested and managed. So you could be as risky or as conservative in the investment allocation. And then you also get to decide where and when those funds are distributed from a charity standpoint. So if you have a charity that you're already making regular distributions to, great, you can continue to do that. If you're just like, look, I need just something to reduce my income, I'll figure out who I'm going to send it to later, you can also do that. You don't have to specify where those funds are going to go to at the beginning. And it can also be irregular distributions. So if you want to wait 2 or 3 years to be able to distribute funds out, you can do that as well. So it's kind of a two-part advantage where you get the ability to be able to reduce your taxable income for that specific spike, and you get to make wonderful charitable donations to one or multiple charities when you decide to be able to do that in the future. Anything you'd add to that, Brian?
No, that you covered it. Okay, let's say that I've got, I'm going to give you a double combo here. Let's say I don't like capital gains and I've got a situation where I'm a dentist. I started my practice 35 years ago, bought a building for $200,000. Now it's worth $2 million. I also bought 30 years ago a lot of the Magnificent Seven that I paid $300,000 for. Now is worth $15 million. Give me some tax relief on those huge capital gains.
Yeah, absolutely. So there's a pretty cool strategy that allows you to be able to use it for either of those circumstances. The most common ways that we see this are sale of a hard asset, a business, a piece of real estate, a rental property, or high capital appreciation and gains. Like you said, maybe you got lucky, you bought Google in 2003, you've held it for the last 22 years, super low cost basis, very high market value. If you were to outright sell either of those assets, it's going to be a pretty hefty capital gain that you would pay taxes on. Now, the way that this strategy works is you set up a specialized account and you have the ability to move that asset, the stock, the property, whatever it is, into the name of this account. Now, from there, you get to sell that and eliminate 100% of the capital gains tax. So you wouldn't pay any capital gains tax on the sale of that asset. And then from there, you can draw a lifetime of income out of that fund. So it's typically about 5% per year of the assets in there that are distributed. And you do still control how the funds are invested. So again, you can put them in various investment vehicles, whether risky or more conservative, to be able to take money out of that account year over year to supply income for yourself. Now, at the end of yours and your spouse's lifespans, the remainder of the assets in that account do go to whatever charity you have specified that is tied to that account. So this is a great way to both eliminate taxes, capital gains taxes on the sale of those assets, and be able to provide some charitable giving, all while giving yourself an income stream to be able to pull for those retirement years.
Now, how are we going to use the massive charitable credit most times, Arrin?
Yep. So a lot of these tax strategies are actually intertwined with each other. And so in addition to getting that income stream, when you do move that asset into the name of this account, you get a tax credit. It's typically about 10% or so of the value of the asset that you moved in. And a lot of people will use that the same year in conjunction with Roth conversions. So again, decreases your taxable income, puts you lower in those federal marginal tax brackets, gives you a larger buffer or dollar figure that you can do those Roth conversions on. So they all kind of work cohesively together.
Okay. So we covered spikes in income. We covered potentially not paying capital gain situation. What about an age difference? Let's say I'm 65. I've got a 401k, married to my wife. She's 10 years younger at 55. What's the tax benefit of that age difference with my 401k?
Yeah, so this is a specific strategy for 401ks. I want to be clear at the beginning that this does not work for traditional IRA. So if you've moved money out of the 401k and into a traditional IRA or a Roth IRA, this does not apply. But for funds that are held within a company 401k, you have a large age gap between you and your spouse. This is an awesome opportunity to be able to move half of those assets. So let's say you've got, I don't know, $500,000 in this account. You take half of that, $250,000, and move it into the name of your spouse. Now, what this does is it gives you a much longer runway to be able to do those IRA to Roth conversions. So in your example, Brian, at a 65-year-old, they're going to have 8 years before their required minimum distributions begin. By moving half of those assets into the name of the younger spouse, you now have added 10 additional years on where you can do those Roth conversions, some of the other tax strategies before those required minimum distributions become applicable. So again, if you have a large age gap, it's usually about 10 years or more, and you have funds in a company 401k, this is a great way to be able to merge that with that Roth conversion strategy. Really make sure that you're not going to have an RMD issue later on.
Okay, now let's talk about the state and federal income tax. A lot of people don't have to worry about, most people, I should say, don't have to worry about the federal estate income tax level because, gosh, right now it's pretty high, Aaron. But let's talk about the state estate tax. For example, we have markets in California, Utah, and Washington, but we have clients all over the country. There are some states, like let's use Washington, for example. Washington has a state estate tax where all assets valued over $2.2 million are taxed at a 20% rate. So there's two parts to this. The first part has to do with making sure that your trust has that AB clause. So go into that. And second is potentially satisfying this, but also, Aaron, a lot of clients, and I think our clients are very smart, very kind, wonderful people. Half our clients say, Brian, I don't care. I'm dead. Whatever my kids get is more than I ever got from my parents. But the other half says, oh, no. After paying a lifetime of taxes, I would roll over in my grave knowing that the state of Washington took another $2 or $3 million just because I died. So no, I'm going to make sure that's not going to happen. I'm going to proactively set aside funds to take care of the state estate tax. So I just handed you a long laundry list of things to cover here, Aaron, but let's be specific about strategies to handle that state estate tax. And I want to go back to first going to the trust.
Yeah. So from a fundamental standpoint, one of the discussions that we have with all of our clients is how they want to handle their assets, right? So our focus is the people that are sitting in front of us. We want to make sure that both while you're alive and after you pass, we have the goals that you want to have put into place. And like Brian mentioned, everybody has a different outcome that they're shooting for. Everybody has different priorities or ranking how important things are versus less important. And we want to make sure to tailor our approach and how we build things to specifically how you want to use those assets. So specifically talking about the estate tax stuff, there's going to be a couple different things that can come into play there. Now, again, make sure to the federal estate exemption is going to be the same for everybody. Right now, it's $13.99 million per person. They can change that number. Again, if the Tax Cuts and Job Act does expire at the end of the year, it's estimated to be about a $7 million estate exemption starting next year. But that number will change over time. But again, based off of where you live, make sure that you look to see if your state specifically has a state tax exemption, because that's going to be different from the federal one. So for the ways to get around that or mitigate that, there's a few different things. So part of it's going to be on what stuff is held under your estate and things that are not held under your estate. And so if you look at the different trust structures, Brian, you had talked about kind of the AB trust structure that can help move things outside of your estate. Go ahead and dive into that.
Okay, on the AB trust, let's say that, Aaron, you have a trust that doesn't have the AB clause, and I have a trust and it does have the AB clause. We both are residents of the state of Washington. When your spouse passes away, you lose your exemption. So you each have a $2.2 million exemption. You don't have an AB clause. An AB clause is when the first spouse dies, you create a decedent trust and you create a survivor trust. And you are retaining $2.2 million in exemptions, totaling $4.4 million if you have the AB clause in your trust. If you don't have the AB clause in your trust, then you you relinquish your $4.4 million deduction from the state estate tax. But there's one other part to that. So when you look and see if you want an AB clause in there, if you have an AB clause, you are giving up your right to pass assets with a stepped up basis. So for example, if you've got a lot of apartments or a large part of your wealth is going to be in real estate or stocks that you want that stepped up basis, if the value of that stepped up basis is larger than 20% of 2.2 million, which is about $440,000, if the value of passing assets with a stepped up basis, where when you die, your cost basis is the value of the stock or real estate as of date of death, if the value of that is higher, then you would purposely proactively pass on the AB clause and choose to receive the benefit of the stepped up basis. But let's say that there's no real estate. For illustration here, let's say there's no real estate and you want to preserve as much of the estate as possible going to your kids. How do you proactively use a tax strategy to minimize or completely pay off the state estate tax or the federal estate tax?
And we'll find out when we come back if Arrin remembers Brian's question. That'll be the key to this whole thing. Headed to our final segment. Do you have questions about any or all of this? 833-707-3030. The team at Decker Retirement is here to help if they can. There's a lot of things that are on our plate when we get to retirement, and Brian and Arrin and the team at Decker Retirement are all about helping you. You're kind of working in this, they're kind of like your CFO, if you will, your chief financial officer, to help guide you so that hopefully you don't make the wrong mistake or the wrong decision. It's all about you and how Brian and the team can help you. That's really what it's all about at Decker Retirement. 833-707-3030, 833-707-3030. Take advantage of this opportunity. 833-707-3030. Back with our final segment right after this. This is Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, on the website, Decker Retirement Planning, under the heading of Safer Retirement Education, there's 12 different things you can download, just things about retirement, the financial world that would be good to know before you get into retirement, including Brian's book on retirement, the Decker Approach book. That's DeckerRetirementPlanning.com under the heading of Safer Retirement Education. Of course, you can always call them with questions, 833-707-3030. Boy, do we have enough? Are we going to be okay if we retire? Will our money last? Will our loved ones be okay if something happens to us? 833-707-3030. Arrin, the question is, do you remember Brian's question from the end of the last segment?
Absolutely. Yep. So a lot of times we have clients that are in positions where they either have assets that are over that federal estate tax exemption, or they're looking to make things simple for their beneficiaries. A lot of times people have had some horror stories from how they inherited their parents' funds or some other inheritance that they dealt with, and they want to just simplify things and make it easy to pay additional federal estate taxes. one of the ways that you can do that is through what's called an ILIT, stands for Irrevocable Life Insurance Trust. And this is a specialized trust that really the main purpose is to hold a life insurance policy. And so the focus here is keeping the death benefit of that life insurance policy out of the insured's estate for estate tax purposes. And so the common benefits of this are, number one, the death benefit at date of death from that life insurance policy is not included in the total estate of that specific person. So let's just say your total estate is worth 15 million. So you're $1 million over that $13.99 million federal estate exemption. If you just left the money as is, you are going to pay that estate tax, that death tax on any amount over that $13.99 million balance. Now, having a death benefit or a life insurance policy in an irrevocable trust means that that death benefit is excluded from the total of your assets, meaning it would not have that federal estate tax assessed on it. So a lot of times this is really helpful for two things. First is keeping you under that limit. The second is if you are over that, the death benefit from the policy can really help pay the taxes or any other costs associated with settling your estate. And so the way that this works is you set up the trust, you put that life insurance policy into the trust, and you have the ability to pay into that over time. So a lot of times if people are trying to reduce the amount of their estate that is subject to that federal estate tax, they'll pay monthly or yearly premiums into the life insurance policy, and that does reduce your overall asset base and puts that money into that trust, into that life insurance policy that doesn't get considered for that estate tax there. So that's going to help dramatically decrease that. It gives your beneficiaries the ability to be able to pay the taxes or other costs out of that death benefit. And it does help you decrease the amount of your assets that are going to be subject to that 40% estate tax.
Good. We've got a couple more to go. Let's say that you've got large gains in your 401k on your company stock. Is there something you can do, a strategy that can minimize company stock gains in your 401k?
Yeah, this one's pretty neat as well. So we have a lot of clients that work for large companies, a lot of tech companies where they get gifted or granted stock options or shares as part of their compensation. And for some, it's pretty substantial. If you have a person that has worked at Microsoft or Amazon for the last 20 or 30 years, they're going to have not only a lot of shares, but a very low cost basis on those shares relative to the current market value of those. So if you were in your 401k to just transfer that money to a traditional IRA and take distributions out, or just withdraw the money directly from the 401k, you're going to pay your regular income tax rates on those withdrawals, which for a lot of these people is going to be in the 24, 32, 35% federal tax bracket. So pretty hefty. In contrast, there's a specialized strategy that allows you to be able to break out the shares, the company shares that you have versus the other investments. So typically within a 401k account like that, you're going to have two parts. You're going to have the company shares, and you're also going to have the other money that you have contributed, just the contributions from your paycheck that you've invested in whatever other index fund, target date fund, whatever you put those funds into. Now, the way that this works is you're able to break out the different amounts. So the funds that are the contributions for you would get rolled over to a traditional IRA. The way that it works for the other funds is you have the ability to take the cost basis for those shares, pay the taxes on those at the point in time that you roll them over. But for the gain portion of that, you have the ability to be able to put that into an account that allows you to pay capital gains rates on those, not income tax rates. And where capital gains rates now are either 0, 15%, or 20%, that's very likely going to be a substantial tax savings for you versus paying your regular income tax rates at 24, 32, or higher. And so again, if you have company stock issued within a 401k that you have, this is a phenomenal way to be able to break those out, dramatically reduce the amount of tax that you're going to pay on those, and really kind of set yourself up for maximum value from that hard-earned money.
That's great. Okay, we're winding it down. We've got a couple more to go. Let's say that you've got a large number of apartments, and is there a way to have that apartment rental income, move that to become tax-free?
So there's going to be a couple different things that you can consider here. Now, one of the ones somewhat related to this that I want to just hit on because I've seen this recently in my meetings. Sometimes parents think, hey, I want to be able to gift my kids assets now instead of waiting until date of death to be able to kind of help boost things for them or to try to eliminate how much of my assets are over that federal state tax exemption. Now, Brian, you alluded earlier in our talk here about the step up in cost basis. And for real estate, that is extremely helpful from a tax mitigation standpoint, where the way that it works is if you, as the original purchaser of that property, pass away and then give that asset, the apartment building, the house, whatever it is, to your beneficiaries, their cost basis or what they quote unquote purchased the property for is the market value at date of death. Now, if instead you give that property to them before you have passed away, meaning you put them on the deed or add them to that property, gift it to them while you're still alive, that eliminates that step up in cost basis. Meaning if your beneficiary, your child, or whoever were to sell that property sometime later, they're going to pay capital gains on the market value versus what you, as the original purchaser of that property, paid for it, which is likely going to be a dramatic tax hit. So I just want to highlight, please do not, and there are exceptions to this, but for the most part, please do not gift those assets, your residence, your real estate to your children or other beneficiaries prior to your death, because you'll eliminate that step up in cost basis. So anything you'd add to that, Brian?
No, that's good clarification. I'm still interested. Is there a way to take rental income and have that become a tax-free income stream?
Yeah. So one of the things that you can do, so if you have rental real estate, you're familiar with depreciation. So the way that it works is you get to write off a portion of that property over an extended period of time. For residential real estate, it's 27 and a half years. Commercial is 39. And by default, most people just take it in equivalent increments, meaning they take 1/39th or 1/27 and a half of that and write it off in equivalent increments over that time period. But you have the ability to be able to accelerate some of those depreciation benefits and get that sooner rather than later. So the way that this works is you pay a third-party company to come in and do a custom depreciation study on the property. There are certain aspects of that property that are going to wear out faster than others. You're going to walk on the carpet, you're going to use the appliances, but things like the windows or the roof are going to have a longer useful life. So typically, once they've broken everything out, you have the ability to accelerate about 25 to 30% of the purchase price of that property within the first 1 to 5 years of owning it. So instead of waiting for 20 or 27 years to get that portion of the depreciation, you can move it up to the first 1 to 5 years and have a dramatically higher depreciation benefit for that time period, which could make a pretty helpful tax deduction for you or write-off based off of the income that you're bringing in from that property. And again, that also helps with Roth conversions, right? Because if you have a total decrease in your overall income, that's going to give you a larger gap within which you can do those Roth conversions for.
Okay, with 2 minutes left, Arrin, let's say that I'm 65 years old, I'm ready to retire, and I just had an idea to create a fantastic, huge, profitable company idea. Do I do that in my estate or my kid's estate?
So it's going to depend upon how you want to structure this. Give me some more details on your example, Brian.
Okay, let's say that I'm already pushing limits on my estate. Let's say that I'm very close to state or federal estate limits. Don't you want the growth of that estate to be with your kids, not your own?
Yes, absolutely. So this is a specialized strategy that allows you to be able, so this is pretty typical for business interests. So let's say you're an entrepreneur, you own a business, and you're looking for the best way to be able to pass the value of that business onto your kids or other beneficiaries. So the way that you can do this is you essentially freeze the value of that property, business, whatever the asset is, for your federal estate tax purposes, meaning that it's kind of a fixed amount market value wise that's going to be assessed on your estate. And then the growth, the appreciation is going to be assessed on your kids as far as their estate stuff. So what it does is it still allows you to run the business, day-to-day operations the same. You have the ability to manage everything, but you're minimizing how much of that value is going to be counted towards your estate and allowing your kids to receive a much higher benefit of that because they're being gifted that while you're still alive, not having that 40% estate tax hit if you were to just leave the business as is and give the whole thing to them at the point in time that you pass away.
As always on Safer Retirement Radio, a lot of ground has been covered today. If you have questions, you want to learn more, how does this affect my situation? How does this affect our situation? 833-707-3030 again is the number to chat with Brian, Arrin, and the team at Decker Retirement Planning. 833-707-3030. There's no cost, there's no pressure, there's no judgment, there's no obligation at all. Can Brian and the team help? That's the question. 833-707-3030. Brian and Arrin, as always, enjoyed it. Enjoy the rest of your weekend.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.